right, so I just wanted to first thing we do, as always, is to look at the S&P 500 and see where we're at. We're totally extended in the S&P. Let's look at the 1 year. Okay, you can see we're right at the 50-day moving average. And we have this sense of euphoria in the stock market. It's going up, and we're overbought for 5 months. And this is kind of the situation where any point in time, we can go down 10%, just because trees don't grow to the sky. And eventually, we're going to have a correction. So whenever there's a correction, right now, we have these moving averages as what a lot of the algorithms use for support of when to start buying. So we have the 50-day, the 100-day, the 200-day, and this is the 300-day. So we're right at the 50-day moving average right now. But we're super overbought, and we're super extended. All right, so let's look at the stochastics and the charts for the S&P. You can see where we've been in an uptrend in the S&P for over 2 years now, and we're at the super top of the channel, and we're overbought. So this is not the time to buy. This is the time if you have some gains, lock them in, or sell. If you're going to sell anything, sell it now, because there's a very good chance we're going to go back down in this channel down to here. Okay, so if we look at our calendar, in the stock market calendar, you can see next week we have an FOMC meeting. There's always volatility around that. So if we're overbought now, just think that's a good reason to correct. Whatever the Federal Reserve says, they're going to take it the wrong way, and the stock market could go down. So that's why I have the yellow around this. We have a holiday coming up on the 29th. So that could lead to some good feelings. But we have tech earnings coming out April 22nd. So right around here, that's when we're going to have a lot of the big tech stocks reporting, and most of the S&P 500 will report then. And that's why April and May are usually good months, because there's earnings that come out that help the stock market go up. All right, so the yields haven't changed a whole lot this week. So there isn't that correlation. We haven't had a problem with the yields. We're staying overbought. This is unprecedented. I mean, this kind of going up. The last time it happened was 1964, and for something like this. So it's definitely unprecedented. It's not out of the ordinary for us to correct, with a bad piece of news. All right, so this year we're focusing on returning to the mean. Healthcare, telecom, financials, biotech did the worst last year, and I think they're going to be doing better this year. And over time, stocks revert to a mean or average. So right now, it'll be like 10 or 15% below where we're at right now if the S&P is trading at the normal range. So we do have this momentum in the stock market where it's going down. I mean, it was 73, now it's 70% above the 50-day moving average, 76 above the 200-day moving average. What that means is most of the stocks in the S&P, if they're over their moving average, that's a sign of momentum. It's a sign of the stock market continuing to go up. So that's all great. Let me see. Okay, so we have one piece of information that could cause problems. One is banning TikTok. There was a House bill banning TikTok. If that passes the Congress, that could have ramifications for a lot of the companies we're watching. So if Apple is involved somehow with retaliatory things, that could be a real big problem. So that could be a problem. And we're starting to have a AI bubble burst. We've had NVIDIA start to go down. Let's look at NVIDIA just for fun. So we had NVIDIA correct just a little bit. This was like a super parabolic move for a stock. And there's a lot of momentum in the name. And a lot of times when a stock like this corrects in some way, then everyone tries to get out at the same time. And that could lead to a market correction. So right now we have just the start of a AI, like an AI bubble bursting. We see March is traditionally a good month for the stock market. And April and May, because earnings come out right around April, May. So right now we have, we're pretty much at our channel, we're at the top of the channel and overbought. So it's been stuck here for a couple of weeks, but it's not a good time to buy. You see, we still have the rates have been going up recently, but that really hasn't had the effect of the stock market going down like we normally see. So you can see both the 2-year and 10-year, basically the stocks are going up regardless if the rates are going up. So that's strange. Okay, that none of the variables here have been changing. We had a little bit of inflation. We had inflation go up just a little bit. Let me see. And the U.S. dollar's down just a little bit. And people are still greedy. Right now, they were extreme greed. Now they're greed. The time to buy is whenever people are extreme fear. And you see, AI sentiment survey, people are still bullish. So that's the opposite sign that you should be buying. And okay, so right now we're actually we're in our emotional gauge, where we're basically in denial. We're starting to see stocks like NVIDIA correct a little bit, and people are saying, no, that's just a temporary, it's a return to the normal, and then pretty soon everyone's going to be selling, and there's going to be capitulation, and then the average investor would sell whenever they're despair. They have that despair emotion. So now is the time, if you're afraid that the stock market's going to go down, now's the time to sell a little bit. If you're afraid, anything that you would sell if you were in a despondent mode, this is the time to reduce your portfolio a little bit. Let's see. Okay, so we haven't had anything this week happen that could lead to a crash. We still have ongoing issues of the U.S. debt. The unsustainability of the U.S. debt, that could lead to us not being able to buy a banana for $100 in 10 years. So that's the one big problem we have with this. But other than that, everything is under control. Okay, let's look at our worst to first. Okay, we have healthcare, consumer staples, and energy are all outperforming now. You can see that when their stock market's going down, when you see the stocks, right now it's going down just a little bit, the S&P, but when the stock market goes down a lot, they're going to gravitate towards more conservative sectors like healthcare, energy, and consumer staples. So I guess that's one good reason why. Another reason why these are going up is we have a return to the mean. They did bad last year, and this year they're becoming more in vogue. All right, so let's see what else we have here. All right. Okay, let's look at these sectors that are going up and down today. Okay, U.S. market movers. A lot of oil stocks. The price of oil isn't going up or down today. It's like flat. I'm surprised that all these oil stocks are going up. I guess that's what we can get from that is we have a return to the mean. People are getting into the unloved sectors that are more conservative. The good thing about the energy sector is they pay dividends and they have a low price to earnings ratio. So whenever the stock market's selling off, people gravitate towards dividend paying stocks and stocks that are conservative, that have low PE ratios. And during times where the stock market's selling off, the ones with the highest PE are the ones that are going to be going down the most. So let's look at what's going on today. Oh, I don't see anything in common. Adobe had earnings, and that they disappointed on the earnings, so they're down 14%. Wow, that's a lot for a high quality stock. So the theme with Adobe is they're integrating AI into their products. So they have like photo editing with AI. So they charge a monthly fee to use their system. So this was on my list of stocks to watch. So I think that's a good stock to look at, because Adobe is a high quality stock, and of course they have a monopoly with the PDF maker. So I mean that's an amazing piece of real estate, having everyone in the world have Adobe Acrobat on their PC. Let's look at look at Adobe. See if it's. I'm thinking it's growing like 20%, but it's kind of overvalued. Its snapshot PE is 48. Wow, that's pretty high. Okay, so let's look at the earnings estimates. So 16. Yeah, they grew 10% from last year to this year. 11%. 12%. Okay, they're growing around 10% consistently. So that if they were, the great thing about Adobe, you can see that they have consistent earnings. Look at that. It's up in a straight line, and it's increasing 10% every year. The problem is it's way overvalued. It's 4 times overvalued because its PE ratio is 48, and it's growing at 10%. So it could drop 5 times where it's at right now. It could drop to 100, and then it'll be fairly valued if you follow that methodology. So that's still a premium. I wouldn't be interested in that. Okay, so that was a good little exercise. Let's look at what other things are going up. Home builders. Let's look at the 10-year. 10-year is going up. So we expect the 10 years goes up. We expect the banks to go down. We expect home builders to go down. We expect anything involving borrowing money to go down. Let me see. Okay, a lot of these are high PE ratio stocks that are top decliners. Let's look at the NASDAQ, see what's going on there. Okay, we see a lot of AI companies in this list. So we have possibly an AI bubble starting to burst. So we have Adobe, we have Intuit is incorporating AI into their products. We have Microsoft, we have Amazon, Alphabet, all AI companies. So it could be that we're having all the AI companies went up like crazy. Now they're starting to correct. So that could be one of the So we look at our list here of things that could cause the stock market to go down. One of them was AI bubble bursting. So, well, anyways, it might be bursting. So it started to go down just a little bit this week and last week. So we'll watch that. For me, when I'm holding Microsoft, I bought Microsoft like in 2008 just because I know they're always investing in new products and they have a lot of money towards, innovation. And if this AI product of theirs doesn't work out, I'm sure they're investing in more products. So right now, I guess it's just selling with the AI stocks. Okay, so now look at the sectors that are going up and down. Energy, materials, industrials. Okay, these are kind of I think there's cyclical sectors that are going up today, and they're conservative. They're ones that pay dividends, and they're ones that are safe. So that's what's doing good today, and the ones doing bad are the high risk ones, the high PE ratios, the stocks that did good last year. And okay, that's good. So seems like every day we have a battle between the conservative stocks and the aggressive stocks. And right now the conservative ones are winning. All right, so let's look at what else is happening here. Okay, so stocks slide with Fed on horizon. Okay, we know next Tuesday is going to be that Fed meeting. So that's a really good reason for people to sell because people are afraid what the Fed might say. All right, so what else is in the news here? Okay, Boeing is continuing to have a problem with quality control. It's like every day you wake up and there's another Boeing story where they have quality control issues. They're trying to buy one of their suppliers, Spirit Aerospace, and I think it's just pretty dicey about how we're following the stock, but it's becoming a really dicey situation because even if they have a monopoly in making aircraft, if they can't make good ones, they're not going to be able to make the sales. So that's an example of a stock that has way too many warts. Every stock has warts, but if you have too many of them, then you have to stay away. Let's see what else is going on today. Okay, that's good enough. Let's look at our talking points. Okay, let's look at Dan Now's picks. So far, his Amazon and Meta, of course, they were stellar picks so far, and they're up 39%. XBI, that's the biotech. XBI is the biotech index. These are companies that don't have earnings yet, really. They're still in development, most of them. So they need to borrow money. So they're at high. They're very dependent on the cost of borrowing. So if the interest rates go up, they're going to have a problem. But so far, everyone but the K-Web and the Texas Instruments have been panning out. So we'll keep an eye on that. There was an article that came out, the Magnificent Seven stocks ranked from the cheapest to the most expensive. Alphabet was the least expensive one with the 12 times earnings if you back out the cash, and Amazon. Next year's cash flow. So they said Alphabet is the cheapest, Amazon, then Meta, Apple, Tesla, and Nvidia. So so that kind of follows what we were saying about Alphabet, how it's still undervalued where it's at right now. One problem with Alphabet is they could be losing some of their dominance. I'm not sure, but the AI ChatGPT, whatever, that could revolutionize search, and that could eat away at their monopoly. So we just have to watch that over time. But right now they're not losing market share, but that is a problem over time. You have to consider when you're investing in it. All right, so let's look at some charts of interest. We saw last week, we were talking about Google, how it was like super oversold, and at the bottom of its channel. Now it's like it's halfway between overbought and oversold. So it's still maintaining this uptrend, which is kind of nice. Let's look at another one, Novo Nordisk. This Novo Nordisk, they had some good news this week, so it's actually starting a new uptrend. This example of a stock it's a healthcare. So healthcare has been doing really good this year. And you see, this is an example of Apple. Look at this. This wasn't an uptrend for over a year, but now it's kind of going sideways. So it looks like we're at a different trading range for Apple. We're going sideways, and we have to watch that it doesn't break down out of here. If it starts, if it breaks out of this range, then you can see you have to look at where it had support before to see where it's going to go next. This is a level of support, and this is a level of support. Okay, but right now it's still at an oversold spot. This is interesting. Tesla is in a downtrend. There's a lot of people that say their aggressive pricing on their cars are causing them to possibly lose money. They might have they might lose their growth, and they might be like an average car company pretty soon. I thought it'd be interesting that they're totally oversold, but they're in a downtrend. So this is like not a time to buy this stock. I thought it'd be interesting to see what the Morningstar and CFRA would said about this. They said that their Tesla is undervalued. This is CFRA, but undervalued by 12%. The things that I was most concerned about in this report was that they're continuing to grow their revenue, and their return on equity is going down. So they're actually, you can see with this right here, they lost, when they reduced their prices on their cars, they lost a certain amount of the profitability, and their return on equity went down. So this is kind of the opposite of NVIDIA. They've doubled their return on equity, and looks like this is one reason why Tesla is going down. They're becoming less profitable, and they're not growing as much. And let's see, Morningstar says that they're right at their fair value. So anyway, it's really sketchy right now because it's in a downtrend, and it's has a lot of competition. There's everyone has an EV now. You see. All right, so let's look at NVIDIA. NVIDIA has it's been the best performing stock probably in the S&P this year, one of the best. You can see that it corrected like 5% this week, and it's totally overbought, and it's starting to go down. So it started a new channel. It's going up like this. So we'll follow that. What I did was I thought it would be interesting to go through to see if the fundamentals changed at all. And it seems like from this year to next year, they're growing at 48%. And after that, it says 18, 10, and 23. That's pretty inconsistent. So this is an example of a stock that's its 4P is 73, growing at 48%. That's 1.5 times overvalued. So the earnings estimates keep changing. Let's look at the forward PE is 35 according to Yahoo Finance. So I guess if you do that, if you have a PE of 35, then they have a PEG ratio of 0.7. So So anyway, they're still growing. We don't. I think these earnings estimates are might not be right because no one can predict what they're going to be selling. If they can continue their growth. Okay, so Morningstar says they're 8% undervalued, and they're raising their fair value for this stock. So you see, CFRA says that they're overvalued by 6%. The one thing about this CFRA report that I saw, they had, look at these return on equity. It was 17, 26, and then it jumped to 90, 91.5. So that's a huge jump. I mean, for a company this big to be that much more profitable is pretty amazing. And the only problem with this kind of stock is you don't know if it's a lot of people reorder, and you don't know if they're going to have a time when they've bought all that they need and they can't sell anymore. So there's a massive up and massive down cycle for a lot of the chips in the semiconductor stocks, and you don't know what time you're getting into that and where you are in the cycle. So that's what makes that difficult, and that's probably why these estimates aren't that great. They're not 48% for the next 4 years because no one can. They can't really predict what's going to be in demand in the coming years. All right, so let's look at Tesla's earnings estimates. You can see that they're kind of flat. I mean, right now their earnings estimates are supposedly to grow 17%. From last year to this year, they're growing 0%. You can see that right there. That's really bad. That's one good reason why they're down now. And so they're estimated to grow 18%, maybe 20% if you want to be generous. Their 4P is 37, so that's 2 times overvalued. So Tesla could drop in half and then be fairly valued, if you ask me. I always do this every once in a while. I look at the mutual fund changes over a year. And we had this Fidelity Zero Large Cap Index Fund. And I compared last year at this time to this year and see what changes that they made. They sold Visa, JP Morgan, and Johnson & Johnson. These were stocks that were out of favor last year. And they added Apple, Nvidia, and United Health. So maybe in the next quarter we'll see, some of these more conservative stocks. These are the ones that are doing good this year: the Johnson & Johnson, Visa, JP Morgan, because of the healthcare is in favor. Okay, people were talking about Google being out of the AI game. They're not competitive with Microsoft. But one interesting thing about Google is they have a competitive edge in generating AI because they have a lot of data, and they have every website in the world is catered to Google search algorithms. So everyone is coded to that, so they know exactly where everything is, and so they have the information to use for their AI training. And Microsoft said that. So that's one good reason why AI, Google is not totally out of the search game yet. I always look for reasons why, and good and bad reasons why Google might be in trouble in the future. But so far there isn't any real competitor to Google right now. When we'll see about that. Okay, I thought it would be interesting to go through some of the stocks that I own and why I own them. Because a lot of times when the stock market goes down and things are crashing, you have stocks sliding, and you have to keep in context of why you own something, and is this things that are happening in the world, are they really affecting the stocks that you have? So I'll tell you the reasons why I hold these and why I'm excited about keeping them. Okay, Apple. One of the greatest things about Apple is they have 2 billion active users. All they need, and they're growing their services income for those 2 billion users around 10% every year. So, and all they need is to add on. Well, not all they need. They need to add services to, get more people to add, pay more per month. And if they can have some killer apps where they can charge residual monthly income, that could be one way that Apple grows in the future. And similarly, hold on. Okay. Alphabet, very similarly, they have 2 billion active users every day too, and with their search engines. And right now they have over 90% of the world's search. And even though there's competitors knocking at their door, they're still maintaining their market share. And right now there's lawsuits against them, but that's example of a wart. They have a wart, and they've had a potential of litigation that they're a monopoly for 20 years, and nothing's happened. And they have lawyers too. So, but they're growing at 14% regularly, and they're estimated to grow 14% consistently. So that's why I like that one. Microsoft, I talked about this earlier. They're of course involved with AI, but they have a growing cloud business. So just think of all the offices that use Office, and they have to use their cloud offerings for Office and Outlook and etc. So that's, and they have a monopoly in Windows, but no one's saying anything about it. But that Windows, they have all these active users that they're now charging per month for services. And they're very diversified. So they have Xbox, they have security, like antivirus, they have Windows, Office, and they're very diversified. So if one AI thing doesn't work, they still have other products to go to. Okay, AbbVie, I bought this originally for the dividend, and they have like a 4% dividend right now. But they had a problem where one of their drugs was going off patent, and they started buying companies to make up that loss of revenue. And so it's more of a dividend growth stock for me. And I'm trying to diversify over time into more conservative sectors. I bought this Eli Lilly like 2 years ago or something. It was a very small position, but recently it's starting to get into a bigger part of my portfolio. Their weight loss drug is doing really good, and they potentially have a new Alzheimer's drug. We don't know about that yet, but they're growing consistently at 30% a year, but their PEG ratio tells us they're way overvalued right now. You see, but Visa and MasterCard both, they're both monopolies. They're like a duopoly. They share most of the credit card transactions in the world, and they're growing around 20% apiece over time. So the theme for these stocks are most transactions in the world are cash, and over time, different countries and people convert to using credit cards. Right. So Altria, they have a 9.5% yield, and they're constantly returning to shareholders. Like this week, they announced that they're selling off some of their investments and returning the money to shareholders. So believe it or not, this company Altria, they're a cigarette company, but they also own Kraft Foods, and they own a bunch of other different types of investments, and so they have more than just cigarettes that they sell. You see, J.P. Morgan. This is the best bank in the world, and they pay a dividend. I bought it just basically for a dividend. And ExxonMobil, I bought that for a dividend too. And it's an example of me diversifying into different sectors. So Procter and Gamble, I bought it for a dividend, and over time they're getting rid of products that aren't that great, aren't that profitable, and putting more money into profitable sectors like maybe Tide. They might make more money on Tide. And Amazon, they're a dominant retailer, and they're in cloud, and they're getting into new businesses all the time. For instance, they're getting into healthcare and drug selling, and so I don't know. It's a pretty nice system they have there, and they grew out their network of storage places for their materials so that they can deliver faster. So they have a moat that no one else can get close to, and they have a delivery service too. But Wells Fargo, I forced myself to buy this just to get a dividend and to be diversified. And Meta Platforms, they're using AI to make a better product for their customers, and they're growing at like 15% a year. They're super overextended now, but I bought it a long time ago, so I'm still holding it. Okay. Okay. So CSX, I bought this like 15 years ago, and my thesis when I bought it was they don't make railroads anymore, and they have to continuously upgrade and make their railroads more efficient, and that's how you do better over time. But this is an example of stock that's heavily correlated to the economy, how good the economy is, because people move more things on railroads when the economy's doing good. Pepsi, I bought this for a dividend stock, and it's in a downtrend right now, but I like it because I bought it a long time ago, and I bought it just for a dividend, and it grows like 2 or 3% a year. And Abbott, I bought this for the dividend too. And right, so Novo Nordisk, I bought a very small position in this. They have a weight loss drug, and it's doing really good. Wegovy. Waste Management is a stock that's basically they have a duopoly with Republic Services, and as the economy grows and as construction happens in America, they get to increase the prices over time. And on top of that, they're automating a lot of their facilities. So if they have an automated garbage pickup or automated recycling center, they can actually make money doing that. So that's their theme, and I'll never sell that one. And I think that's good. That's good enough. Okay, I wanted to review I do this once every month or two. What my theories are for buying and selling in the stock market. And right now we're actually at a point where in the stock market we're at a high, and the stochastics are high, and it's been elevated like this for a long time. So that's the time you sell. When the stock is down and the stock is at low stochastics, that's the time you buy. So we haven't had a time like that in quite a while in the stock market. So it's only time before we correct to a point like that again. Whenever you're investing, you have to try to get a little bit into every sector so that you have a well-diversified portfolio if you're interested in a total stock portfolio. So you have to kind of rank how every one of your stocks falls in what sector it's in. And at the end, you want to try to get like a kind of an even percentage so that whenever one sector goes up, other sectors, or whenever one sector goes down, you have other ones to make up for that. And let me see. All right. Okay, so I wanted to also review what it takes to buy a good growth stock for buy and hold. I review these every week. The E-Trade earnings estimates. It basically tells you how much analysts are expecting that stock to earn over the next couple of years. And if you divide these years out by 22.03 divided by 24.96, you get a growth rate. And that'll tell you, in general, what the earnings growth is going to be. And these are the fields that I'm looking for. I'm looking for a growth rate over 10. I'm looking for a forward PE that's, if it was growing at 10, I want it to be a PE of 10 or less, unless it's a really good, high-quality stock. So profit margin is very important, and return on equity is important. So I think that's important. Let me see. Okay, and I wanted to show this chart again. I do this once a month. Last year we had the tech stocks doing really good, and the healthcare sector doing bad, and you had the financials doing bad 2 years ago. And whatever does bad last year, that's a very good chance of doing good. This is why we've been tracking the return to the mean every week, because it's turning out that the drug stocks and the oil stocks and etc. Those are turning out to be the better stocks this year. And my guess is, there's going to be some big tech stocks. I mean, tech stocks might not be performing as well this year because they had a good last year. So you have to keep in mind to diversify your portfolio, because you never know what sector is going to be in favor or out of favor during the year. And part of being a good investor is you have to be diversified, and so you can grow consistently. All right. So I think that's all I had to say for today. All right. So is there any questions anyone wanted to review? All right. I'll take that as a no. Any questions?
Greg, can you hear me?
Yeah.
Greg? Okay. I just have one question. Your evaluation, you talk about having the PE, ratio. Do you change that if interest rates change, or how do you come up with that number as your valuation metric?
Okay.
I guess.
Yeah. I think let's go back over.
Growth.
Okay, let's go over our chart for, there it is right there. Okay, so yes, definitely people pay more for stocks when the interest rates are down. So for instance, in 1981, you had a lower, like a 2% treasury, and the PE that people were willing to pay for the stock market was 26. And so there is a formula we could use, like what is the current 10-year treasury, and what is the you probably multiply that by a certain percentage. Like for instance, if it was 1, the interest rates were 1, then you'd pay a lot more for that, right? So of course we could have a formula for that. But
it seems that when kind of interest rates, as a value investor, when interest rates are high, you're gonna find lots of companies that are like a good deal. When interest rates are low, your screening for value investing is going to be very slim, and it just seems like you might be making kind of poorer choices, I guess. The interest rates if you're really fixed in on just one kind of value metric there.
Yeah, I think I use that value metric just so I could have a consistent way to evaluate a current position. Like for instance, if it's currently overvalued and it's a larger part of my portfolio, I'd want to probably sell some, and I guess that's the method I used. If you can come up with a better one, that I like to hear about it.
No, I was just curious, because that's been one of the tough things about being a value investor for not the last 2 years, but like the 10 years before that, is that there were just very few companies that was hard to find what would be considered like a good deal as a value investor. And I think Warren Buffett kind of ran into this where he couldn't find companies to buy based on like, just there was very little value out there, but it was hard to tell based on kind of growth, interest rates and stuff.
Yeah, he said that this year. He said he has like 160 billion in cash. He says he can't find anything to buy. He might just buy his own stock, but he likes. I think what Warren Buffett. If you look at our S&P chart, this is like pretty outrageous. Warren Buffett's not going to buy at the top of this. He's gonna buy whenever it's down to here. Whenever everyone's selling.
He actually didn't. I don't think he made a lot of big moves during the COVID crash. I think that was also a hard time to stock on.
Yeah, that was interesting. He sold airlines at the bottom of the COVID crash. That was pretty untimely, but yeah. So Warren Buffett keeps he waits for days when the market's selling off, and whenever things are super overextended, like right now, he just basically doesn't do anything. He says he has it's like playing softball. You have an unlimited amount of pitches. You just wait for the pitch to come that you want, and he's waiting. He hasn't bought something in a long time.
Okay, no, that was my question. Okay.
Oh, okay. All right. So, any other questions? All right, that was a good exercise. All right, well, I hope you have a good rest of your week, and if you have any questions for next week, let me know, and I'll prepare something for next time. All right, thanks.
Thank you.